To kick things off, I want to give you a big picture view of what's going on with housing right now, because the landscape has shifted quite a bit this past year. If you felt like the market was moving at a breakneck speed before, you'll be relieved to know things are finally settling down. We are seeing some significant changes in prices, who is buying, and what the future looks like. So let's walk through the 10 biggest takeaways from the latest data so you can feel confident about your next move. You might have noticed that the housing market felt a little different the past year, almost like it finally stopped to catch its breath. After years of running at a sprint, home price growth slowed down quite a bit in 2025. Back in January, prices were still climbing steadily, but by October, that growth had cooled significantly to just over 1%. That is actually the slowest pace we've seen in over a decade. It wasn't just a slowdown in growth either. About a third of the biggest metro areas in the country actually saw prices dip compared to the year before. This shift has given buyers a little breathing room, which was much needed. Interestingly, even though home values leveled off, the total wealth tied up in housing hit a massive record high, prompting a lot of homeowners to borrow against that equity. We also saw a split market depending on where you looked, especially in places like Washington, D.C., where government layoffs pushed inventory way up. Investors stayed busy buying homes, but for renters, things got a bit easier as rent growth slowed down. Looking toward 2026, the experts at the global property intelligence company Coldwell expect a modest recovery, but affordability is still going the main hurdle we all have to watch. So let's dig a little deeper into what actually happened with prices. We started 2025 with decent gains, but by the fall, the market had shifted gears entirely. In a span of just 3 years, we went from seeing 30% jumps in value to seeing actual declines in many areas. At the beginning of the year, only a handful of cities were seeing price drops, but by October, that number had surged to include over 30 major markets. We're talking about places in Florida, Texas, California, and the Mountain West where sellers are having to adjust their expectations much more than before. Inventory tells an interesting story too. While the number of homes for sale across the country went up a normal amount, the Washington, D.C. area was a completely different animal. Listings there skyrocketed by 60% compared to the previous year. In some specific pockets of the northern edge of that metro area, the number of unsold homes jumped nearly 70%. It really shows how real estate is always local. While one town might be tight on options, another can be flooded with for sale signs. That surge in inventory in the DC area didn't happen in a vacuum. Homes there sat on the market much longer, with the median wait time jumping by over a third. This was way higher than the national average. The main driver there was, unfortunately, economic instability, specifically large-scale federal layoffs and the government shutdown in the fall. When people are worried about their jobs, they don't buy houses. And you can see the direct result in those numbers. Despite the cooling prices for regular buyers, investors didn't seem to mind. They stayed very active, spending nearly $500 billion on single-family homes. To put that in perspective, investors bought roughly 1 out of every 3 homes sold through October. They're on track to spend even more than they did the previous year, proving that big money still sees American housing as a safe bet. For first-time buyers, the age gap is widening depending on where they live. The typical age for someone buying their first place is still around 32 nationally, but geography plays a huge role. In expensive coastal cities like Los Angeles, San Francisco, and New York, first-time buyers are typically in their mid-30s because it takes longer to save up. Meanwhile, in more affordable spots like in the Midwest and South, like Iowa or Indiana, people are getting keys to their homes in their late 20s. If you're renting, you likely felt some relief this year. The growth in single-family rents slowed down to its weakest pace in 15 years. We went from just a few cities seeing rent drops to nearly 20 major metros experiencing declines by the fall. However, context is key here. Even though rents dipped recently in places like Cape Coral and Northport in Florida, those same areas are still up roughly 30% over the last 5 years. So, while the cooling is nice, it hasn't exactly erased the massive hikes from the pandemic years. On the financial side of things, homeowners are sitting on a mountain of equity. The total value of residential housing in the US peaked at over $48 trillion this year. Since the start of this decade alone, the market has created an incredible $18 trillion in housing wealth. To give you an idea of how wild that is $6 trillion more than what was created during the entire decade of the 2010s. With all that wealth, we saw a slight uptick in people struggling to make payments. The share of mortgages that were seriously behind schedule crept up just a little bit. This was mostly seen with FHA loans, which are often used by buyers with lower down payments. In contrast, borrowers with VA loans and conventional loans actually performed better than before. It's a reminder that while the overall market is strong, inflation and economic pressure are making things tighter for some households. Because there is so much equity available, home equity lending exploded to its highest level since 2008. Lenders gave out over 500,000 new home equity loans in the first 9 months of the year. People are realizing they have a lot of wealth tied up in their house and are deciding to tap into it, whether for renovations or consolidating debt. It's becoming a very popular financial move again. So what does 2026 look like? The forecast calls for a slow and steady recovery. We expect home prices to tick up about 3% nationally, with the Northeast and Midwest likely leading the charge. Mortgage rates will probably stay above 6%, so we aren't going back to the ultra-cheap borrowing days just yet. The biggest risks remain affordability and the rising cost of owning a home that have nothing to do with the mortgage, like insurance and property taxes. These escrow shocks could catch some folks off guard. It's going to be a year of modest growth, but we will need to keep an eye on those monthly costs. To wrap this all up, the market is essentially taking a deep breath after a marathon run. We are moving away from the chaos of the last few years into a period that is slower, more predictable, but still holds its own challenges like high insurance costs and interest rates. 2025 was a transition year, a necessary bridge between the chaotic boom of the last few years and the more sustainable future. While we aren't seeing the wild appreciation of the past, we also aren't seeing a crash. Instead, we're settling into a market that values patience and smart financial planning. As we move into 2026, the key will be to focus on the long game. Whether you're looking to buy your first home sell your current one, or just trying to figure out what your home equity is worth. I'm here to help you navigate these changes so you can make the best decision for your family. Thanks for watching, and I'll see you in the next video.